I am surprised that people still don't understand it. It seems like buying into the AI bubble is the worst decision one can make now. It feels like buying Bitcoin at the all-time high. But when we look at the data in a bit more detail, things aren't that obvious anymore. What we see here is the Nasdaq 100 over the long term. And this looks like the textbook definition of a stock bubble. And even when we look at the Nasdaq 100 relative to the US money supply, we are now above the valuations compared to what we had during .com. At the height of the .com bubble, prices fell relative to the money base by 85% in the span of 2.5 years. Is it really that smart to buy into technology stocks now when they're even more expensive and when there's the risk of them falling 85%? Can we really take that risk? Now, investing is a game of opportunity costs, right? We have to consider, where are we parking our money? Imagine you had 100 million US dollars. You would not keep that capital in fiat, right? You can't just leave it to the US dollar, which debases on average by 6.8% per annum. Right? This is how quickly USM2 grows, 6.8% per annum. So if you just leave your capital on the sidelines, you'll just lose 6.8 million per year. So you have to put it into something. And then the question is, into what? So really what we have to consider here is, what are the alternatives? What is the opportunity cost? Does it make sense to buy into technology stocks at those high valuations, given when we compare this to the rest of the market? Let's do the most straightforward comparison. This is now technology stocks, so the Nasdaq 100 relative to the entire US stock market. So that's the S&P 500. We're looking at that ratio, technology stocks versus the rest of the stock market. This is a chart that starts in 1985. So that's more than 40 years of data. And what we see over here, that purple square, that's the .com bubble. Tech stocks outperformed regular stocks by more than 200% in the span of 2 years. And then they corrected subsequently and fell, relatively speaking, by 70%. They fell more versus the money supply. They fell by 70% relative to the rest of the stock market. So we clearly had market exuberance at the time. The market was extremely hot. Random companies just added .com behind their name and suddenly the price went up. Now, is the same happening today again? It's not as clear, as in, yes, technology stocks are now more expensive relative to the rest of the stock market, but we haven't seen that quick of an appreciation. We are just in line with the general rate of appreciation of tech stocks relative to the rest of the stock market. Now, why should tech stocks long-term outperform the rest of the market anyways? I think it has two reasons. The first reason is that tech stocks, on average, they are growth stocks, so they tend to pay out less dividends. And since both the Nasdaq 100 and the S&P 500 are both price indices, if you retain more of the earnings and you don't pay them out via dividends, then your price on average should appreciate more. But that's of course only part of the story. We also see how the economy itself moves more and more into technology. We pass more and more time with technology, we spend more and more of our money on technology, and technology is very easy to scale. So once you're the market leader globally, you can very easily scale this around. The incremental cost you have for acquiring a new customer or for serving a new customer is very, very low. Once you've got the best technology, you can just ship this everywhere and dominate everything. So because of that fundamental principle, it's much easier to dominate the globe with a single company. If you have the best automaker, for example, you need to have different facilities everywhere, right? You need to ship everywhere. It's much harder to expand moving atoms compared to just moving bits. And so that's why technology tends to be higher margin and tends to be more concentrated into a few winners. And traditional businesses have a very hard time competing with those fundamentals. Now, this actually only shows half of the story. This just shows that technology stocks did better than the rest of the stock market. But what we actually have fundamentally going on is that the market is concentrating towards the winner in general over time, even before technology was a thing. We can see this in this chart here. This chart starts in 1990, and what we've got in blue, that's the S&P 1. What we've got in orange, that's the S&P 500. Now, what on earth is the S&P 1? It's just the largest stock at a particular point in time. So this used to be General Electric, then it became Microsoft, then it became ExxonMobil, then it became Apple, etc. Today, it is NVIDIA. Over all of those years, on average, the S&P 1 did much better than the S&P 500. The average return with the largest stock was 17.5% versus the entire S&P 500, 10.5%. So an additional 7 percentage points every single year. That means $100 invested over the entire time period did not just become $4,000, but almost $40,000. So that's close to a 10x difference simply by buying the largest stock, not by buying the largest 500 stocks. And intuitively, this makes sense. If you are the largest company, then you're also the most desired company. You can pick the talent, right? If you are the best performer in your particular niche, then you're going to go to the biggest company. It tends to pay the most, it tends to have the best benefits, it has the best reputation. All the other companies are just your second choices. So the other companies, they have to somehow outcompete the number one. They have to pay you more, or they have to give some other kinds of benefits. So really, there's a big advantage of being number one, and monopolies tend to just manifest over time. And that's why they can perform more than the average. Now, the number one changes over time, and that's often an expression of industry shifts, not necessarily as much the market leader within an industry changing, but now not necessarily the market leader within an industry changing, but we have seen how Apple dominated this for a while, and now it's NVIDIA. And that's because Apple did not invest as much in artificial intelligence. And artificial intelligence is where currently all the revenue growth is. Here's the same on a bar chart. So the S&P 1 in blue, the S&P 500 in orange, and here is the outperformance. So the vast majority of years, the largest stock outperforms the overall 500 stocks in the S&P 500. And we are just looking at yearly rebalancing. So we're just looking at the largest stock at the beginning of the year and then hold it for the year. That's all we do. There's no rebalancing within the year. Now granted, holding only one stock is more risky than holding 500, right? The annualized volatility is 27%, not just 17%. But is that additional volatility worth it, given we get 7 percentage points on average more per annum? I think it is. Now this analysis would imply that right now we should be buying NVIDIA. And that goes entirely against the fear that we expressed at the beginning of the video, that we are buying into the AI bubble. Now what about specifically NVIDIA? Is NVIDIA maybe fairly priced within that AI bubble? Does it make sense to buy it now? Now check out this chart. This is the NVIDIA price relative to the Nasdaq 100. NVIDIA did much better than your average technology stock, but have a look at this. In the last 2.5 years, NVIDIA has not outperformed the general tech market. It has just gone sideways. If you buy into the narrative that artificial intelligence is going to replace a lot of manual labor, it's going to replace a lot of office jobs, etc., then NVIDIA is probably going to benefit from this majorly as well. But when it's got such a strong monopoly, such a strong moat, why didn't it do better than the rest of the 100 technology stocks in the last 2.5 years? I think we do have a bit of mispricing here. I think that NVIDIA, at least in the near future, tends to rather be underpriced. Buying the largest stock in the US in general is a good idea. Buying it when it didn't even outperform in the last 2.5 years is probably an even better idea. The picture for the next two contenders, so be this Apple, I don't think it doesn't look as good. Apple is underperforming the rest of tech because it's not innovating quickly enough. Google is very much benefiting from artificial intelligence. And very long term, it also tends to outperform the Nasdaq 100. But recently, with the adoption of Gemini, it has seen quite a bit of a rally. It has outperformed by 80%. And so yes, Google might be a long-term outperformer, but will it outperform in the near future, given that it has already run so much? I'm not so sure. I think among those three technology stocks, Google, Apple, and NVIDIA, I think NVIDIA is the best bet It's the largest of the stocks, and it has not outperformed in the last 2.5 years. And it could very much outperform soon again. Now, please don't misunderstand me here. I'm not advocating for putting all of your money into NVIDIA stock and forget diversification. What I am saying though is that diversification can be smarter compared to just buying 499 other stocks. The stock market tends to be highly correlated, right? So when NVIDIA goes up, then many other tech stocks go up as well, and vice versa. When it goes down, everything else goes down. Diversification, in my opinion, is not achieved by buying many assets within an asset class, so owning 500 different stocks. I think better diversification is achieved by owning different asset classes. So we want to have the best stock, we want to have the best cryptocurrency, we want to have the best precious metal, we want to have the best property. We want to have those different things that aren't highly correlated, but we want to pick the best thing within the asset class. So in crypto, that's probably Bitcoin most of the time. In the stock market, this might be NVIDIA. And discussing property here, or precious metals, or raw commodities, that's something for another video. I think it's okay to buy into the hype, to buy into something that has the potential to outperform. And I think NVIDIA is still comparatively okay with its valuation. I personally do buy into the hype of artificial intelligence. Once you start coding with artificial intelligence, once you start building applications, once you start automating processes with artificial intelligence, the value creation gets obvious. I'm using AI, for example, to post now the videos on various platforms, to generate shorts, to create the captions, to build backtesting platforms like this. This was built via artificial intelligence. And I actually made a tutorial video on that as well. Building backtesting applications without coding knowledge, building useful programs is getting easy, etc. This is all part of the premium membership of this channel. I'm sharing my own investment ideas, my data-driven approaches, and also my personal traits. If it's your first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Link to premium pops up here on the screen. There's also a 7-day money back guarantee. So in case you don't like premium, just message me within the first 7 days and I'll refund you. No questions asked. Thanks for watching and see you next time. Cheers.